So with the market at all-time highs right now, it's tempting when you look at your Fidelity app or your Schwab app to say, you know what, let me just sell this portfolio and wait until things take a downturn and then buy back in. The market's been on such a tear since the spring. A lot of people are having this question, should I sell at all-time highs, or should I stop contributing when the market's at all-time highs? So I wanted to take a look at some data today, 3 reasons why you shouldn't do that, and 1 very good reason why you should, and I'll go over that. So my name is Zach Lundak. I'm an hourly financial planner, and thanks for watching. So the first reason why you should not sell because the market is at an all-time high is because the market is at an all-time high most of the time. It's like a shockingly high percentage of the time the market is at or near an all-time high. So this slide from JP Morgan does a great job of highlighting that. On the left-hand side, we'll look at investing at all-time highs. What does the data say? So they went back to 1950 and looked at the S&P 500. This is the key though. Percentage of days the S&P 500 closes at an all-time high. Not even touches an all-time high, closes at an all-time high. 6.7% of all the trading days. So that's a lot higher than I think a lot of people would guess. But if you want your mind blown, take a look at that line below. It says percentage of all-time highs that act as a market floor. So if you look at the footnote, it's not quite as shocking as this makes it sound. But how they frame this up is whenever you reach that all-time high, 30% of the time, that is the new low in the market. Meaning if an investor sold at that point, they would have got a chance to buy back in at a lower price. Now it's not quite all the way true, because if you look down here at the footnote, they say a market floor is defined as an all-time high from which the market never falls more than 5%. So it's not truly a floor, but it's pretty darn close. I mean, if you sold at an all-time high and then the market was down 4 or 5%, I don't think you would be thinking to yourself, oh, well, that's a screaming deal, let me buy back in. So effectively it's a floor. And almost a third of the time, if you sold, you are not going to have an opportunity to buy at the same price. You're going to be buying higher, which is really, really hard to do. I think everyone's been there before, but man, that's tough. I think it happens a lot in single stocks. So this chart on the right is interesting as well. They looked at S&P returns from the end of 2024 through January 88. So what it's saying is, hey, what if you invest at an all-time high on the day versus any other day? So the first strategy in gray is any day you can invest. What's your return going to be that following time period? 3 months, 6 months, 1 year, 2 year, 3 year, 5 year. And they look at rolling returns there, and they aggregate all that data together versus what if you only invest on the all-time high, the days that it closes at an all-time high. And in every case, you would have been better off buying at an all-time high, which is just crazy to think about. That doesn't make any sense, but that's what they show in the data. This is JP Morgan, the largest financial institution in the world, and they're putting this out there. So I trust it, but man, that sounds like totally backwards, doesn't it? So another point to show here before we move on to point number 2 is we saw that any given day, it's like a 7% chance that you're at an all-time high, literally closing at an all-time high in the S&P 500. But I wanted to look at what is it? I mean, it's like we're not at an all-time high, but we're near an all-time high. What does that feel like? So if you're within 10% of an all-time high, what percentage of days does that include? So this table here from Bespoke breaks it down, and it looks at all-time high. Like we said, they rounded it, but it's 7%. JP Morgan said 6.7%. And then I added up all of these to go between at all-time high and 10% below an all-time high, which effectively feels like an all-time high, right? You add up all of them, over half the days you're within 10% of an all-time high. It's actually closer to 60%. You could round to 60%. It's 59.6% of the time, according to Bespoke, the S&P is at an all-time, or within 10% of an all-time high. So point number 1, you want to sell because the market's at an all-time high. Well, guess what? It basically always is. So that's not a good reason. So point number 2, the market is very concentrated right now. We see in the news every day these tech companies, the Mag 7, are a greater and greater percentage of the S&P 500 and the overall U.S. economy and the stock market value. There is this chart going around from Torsten Slok at Apollo Group that highlights how crazy this has gotten in the recent years. It's really interesting too, because it makes you feel like, oh, is this 2000, 2001 all over again? But basically what we're showing here is, so the share of top 10 companies by market cap in the S&P 500 is the blue line, and the green line is the share of the earnings attributed to those companies. So you can see back in 2000, at the height of the tech bubble, we got up to, call it 26, 27% market cap in those top 10 companies, versus those companies were only earning 16 or 17% of the profits, which would be like a 1.7 to 1.8 times difference there right before the crash. But that seems quaint when you compare that to today, because now we're approaching 40% in the top 10 companies. Again, this is as of June, it's actually a little bit higher now. This is 39. It's closer to, you could round it to 40 now, according to the JP Morgan data. 40% of the value of the S&P 500 is in these 10 companies alone, and they're only earning 25% of the earnings, which would be like a 1.6x. So eerily similar to that pre-tech crash valuation discrepancy there, the difference between the market cap weighting and the earnings of those top 10 companies. So if this makes you feel sick to your stomach, that's probably a good thing, because if you remember back to 2000 and what happened to the NASDAQ, which is like the tech indice after the crash, it was devastating for investors. So if you look at this chart here, you can see the NASDAQ since 2000, it looks like it's been a great investment. But if you zoom into this time period from 2000 through early 2000s, mid 2000s, it was a rough time period. In total, from 2000 to 2012, the total return from the NASDAQ 100 was negative 28.7%, or an annualized rate of negative 2.3%. We don't want to do that again. Yeah, we're going to avoid that if we can. It's just awful time period. And of course, it's done great since, but all that together, you have averaged an 8% return if you're able to stick with it, which a lot of people would have a tough time doing. So you might say, well, Zach, that's just evidence we need to sell, right? And I would say, let's look at another chart. This again is from Guide to the Markets from the JP Morgan, and it paints a little bit of a different picture here. We can see they do the same thing. They go back and they look at the weight of the top 10 stocks in the S&P 500. They go back pre-tech crash through today, the earnings and the market cap. They use gray and green here. But if we look at, so their numbers are pretty close. I've got their numbers here. I just, from my eyeballing it, it looks pretty close. So 1.7 times market cap versus earnings for Apollo versus 1.5 times. We'll call that even. That's pretty darn close. And just me eyeballing it, that might be off because I don't have the markers on the charts. But if we go to 2025, Apollo versus JP Morgan, this chart paints a different story. So maybe discount the Apollo chart a little bit and look at another data source. They're both saying they've got about 39% of market share in the top 10 companies, but the earnings are wildly different. So Apollo's saying those top 10 has less than 30. JP Morgan is saying they have above 30. A big difference here. So if you've seen this chart, so basically my point is, if you've seen this chart from Apollo, I'm not sure which earnings they're using for this 2025 number. JP Morgan is using a different set clearly, and it paints a much rosier picture for the earnings power of these top 10 companies that might put you at ease if you are especially nervous about the concentration in the market right now. So just because you see one chart, you have to look at other charts and other data. You have to understand where this data is coming from. So for that reason, I would say this by itself is not a reason to sell. So another reason to sell might be, you say, Zach, just given the political climate, there's so much uncertainty right now. Wouldn't it be best to sell right now and buy back in at lower prices? To which I would reply with this chart and say, look at all the horrible stuff that has happened politically, geopolitically, wars, and the market has hung in there. Now, it's certainly not every time, and there's certainly going to be things that happen that do send the market lower, but it's not a reason in itself. The reason being is because markets are forward-looking, and everyone else participating in the markets understands that we are in a little bit more of an uncertain time where different things could happen. So go down, look at all these crazy geopolitical events that have happened and their returns subsequently. You can see usually down the day of, but total drawdown and then recovery are a lot quicker than I think a lot of people would expect, just given the severity of these events. So again, this by itself is not a very good reason to sell at all-time highs and get back in at lower prices. So finally, what is a good reason to sell? A couple of things. One, if you feel physically sick from the market moving up and down and checking the news and checking your balances on your app, then it's probably a good sign that you have too much risk in your portfolio and you should sell some of your exposure and have an allocation that you can stick with. Because if you don't, you're going to make a big mistake by selling at the wrong time when things do get really difficult, and they always do in the markets. The second thing would be, just given the run-up in stocks over the summer of 2025, it could be a situation where your stocks have drifted higher than your target allocation in your investment policy statement. So it could be a good time to trim those back to your target allocation so you don't have more risk than you anticipated or planned for. That would be another good reason. Or finally, if you have an expense coming up, certainly within the next year, but maybe even the next handful of years, a big trip, down payment on a house or a boat or something like that, might make sense just to go ahead and set that aside and put it in a money market security or something like that, just to have the peace of mind that no matter what happens in the market, you're still going to be able to accomplish that goal or do that thing that you want to do. So hope that was helpful. We'll see you guys later. Bye.